when I think about an investor's portfolio, the most important thing, a portfolio should be tiered in the form of risk, and that diversification is very important because any bet on any one thing can be wrong. I think that first tier of saving should be based on, am I going to have enough money, enough buying power for my needs? And that tier should be well saved and almost have it diversified. So things that do well when conditions improve, like, the stock market and so on, and do well when things do badly. That might be gold or, others. The way I like to think about it is there are two main drivers and they can go up or down, and the markets reflect those things. What are they? Inflation and growth. And then inflation can rise or fall, and growth can rise and fall. And if you can have a balanced portfolio of those, like 25% of your risk in each one of the portfolios that would do well if that happened, you have a balanced portfolio, then you're going to have an element of diversification so that you're not exposed to one scenario. And once you've got that portfolio established, so you can think, how many weeks, months, years can I live, on that? And so you have your safety, bulletproof portfolio, but it can't be in cash. Like, people think cash is the least risk investment because I hold it and it doesn't go up and down, and I receive my interest rate. Well, it depends on the interest rate that you have in relation to the inflation rate, because otherwise you can have a bad result because of inflation. So you have to think about it in real buying power, and you have to have it as a diversified portfolio. So those are the things that I would emphasize to do, and to have it also diversified internationally. So my thoughts about bonds or debt is that probably in the long run, it will not be a good asset to hold because there's a lot of debt, and it's very difficult to have that debt paid off with an interest rate and a return that's positive after inflation. To provide that good return makes it very difficult for debtors to pay that money. So, a high enough interest rate to satisfy creditors is too high of an interest rate to not hurt debtors. So I'll offer thoughts like that. I would emphasize that the three things I look at most is, how's the finances? Is the country just like a company or an individual? Are they earning more than they're spending? So they have a good income statement. Do they have a good balance sheet? Second, do they have internal order or disorder? And third, are they going to have a conflict? I'm not saying get out of the United States, and I'm not saying get totally out of China. As a general rule, I want to have my risk broken up into 10 to 15 uncorrelated good assets. And so that means I don't want to have more than 10%, ideally not more than 7.5% in any one of those good assets. If I'm judging goodness, I'm judging it by, what's their income statement, finances like? Are they having internal conflict? And are they in the midst of being in a war? I want to stay away generally for those, but I still want some of those portfolios in that. So that's good diversification for me. Dollars are debt. In other words, when one holds a dollar, a central bank, they hold a debt asset. And generally speaking, the world is holding a lot of US dollar denominated debt. So the holders of that would say, I'm already overexposed to US dollar denominated debt. And so there's less of a eagerness to buy the debt. And that eagerness to buy the debt is also reduced by, two main things. One is the United States share of world trade has gone down and China's has gone up. And so you save really for spending internationally for that reason. And then also sanctions have increased the perceived risk that those debt assets can be frozen in the way that they've been frozen for Russia. So around the world, different countries increasingly have that risk. So for those reasons, there's less desire to hold US dollar denominated debt, which means less US dollars. So the supply demand picture is worsening, particularly as we continue to have to sell them internationally to fund the deficit. Let's start the story in 1945 by way of example. there's a war, and then after the war, the winners of the war determine the new system, the new order. And we created a new monetary system, and we created a new world order. That's the American world order, because the United States accounted for half the world's economy. It owned 80% of the gold, which gold was money, and it was a dominant military power. And so nobody wanted to fight it, and it determined the world order and so on. You have peace, and then you build peace and prosperity because nobody wants to fight, and people work together, and they're so distraught of a war. They don't want to enter into that, but now they have peace and prosperity. And then you have the 50s and the 60s, and then you begin, and these cycles always happen. You get more peace and prosperity, you get more development of the capital markets and borrowing because things go up and they do well, and also a reserve currency of the countries that are, have been beaten up, want to hold, because that's their way of saving. They build these reserves, which is debt in a country. And so that debt that they're owning, like dollar bonds and so on, becomes a debt of the United States. It's called the exorbitant privilege. You can borrow and you get over indebted. And also in a normal capitalist system, income gaps and wealth gaps increase. Those who do well earn a lot, and those who don't do as well don't. And so you have greater and greater wealth gaps. And then as time progresses, you have more indebtedness and you have more wealth gaps and so on. And then you start to have economic conflicts. And of course, at the same time, where the country is dominant, other countries repair themselves and start to grow. So you see Japan in the early years, Japan and Germany coming out of war destruction, healing themselves and becoming competitive in the world markets. And then, take you through history, then you have the great overspending, and you have 1971, a debt problem because we tied the value of money to gold. And so because we had way too much claims on gold than we had gold in 1971, they defaulted. The United States needed to default on its obligations to convert these IOUs to gold. And then you have the 70s. But anyway, you have these cycles in which then debt rises and gaps occur and so on. And then you find yourself in the position that we find ourselves. You find ourselves in a position where, the problem is we spend more money than we earn. We are in debt, and we have large wealth and opportunity gaps and large values gaps. And then there's a lot of fighting over those things. And they're not easy to repair at that stage because, let's say, what do? You want to get financially stronger. Okay, financially stronger means you earn more than you spend. It's so easy to say earn more. Well, it's not easy to earn more. And then what? Or cut expenses. You're not going to cut expenses. And then you deal with taxes to try to make the balance, and people don't want to get taxed, so there's a fight over holding on to wealth and how that works. And then you have this polarity and you say, well, you've got to have this problem dealt with in a united way, smart, united way to make the difficult choices. But it's very easy to say, but you have that fragmentation.